Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I'm going to talk to Ahan from Beating the Market on Seeking Alpha. My marketplace, Deep Value Returns, is a marketplace where I talk about growth stocks and talk about value stocks. So it's kind of a hybrid portfolio. Ahan, can you tell me a little bit about your marketplace?
Hi, Michael. So I work at Beating the Market. I'm a quantitative finance master's in quantitative finance. And at Beating the Market, we are looking at growth and hyper growth companies. Um, so that's our area of expertise, and that's what we buy.
Cool, very cool, man, very simple. So we're going to talk today about Zoom. So Zoom is a stock that everyone knows about. Lots of retail investors know it. A lot of institutions know it. We are actually talking via Zoom, so we know it, like we're kind of going through the process right now. So in the past, let's say several months, there's been a meaningful sell-off in growth names, and Zoom has not been immune to that. How has that been to as an investor? Has it been an easy process? How have you felt through that?
So, Michael, let me back out the chart a little bit and start with how Zoom has behaved since the pandemic hit us back in, say, early March of 2020. And I think when investors really started understanding how Zoom's numbers went parabolic in terms of growth, there was a lot of excitement, and that then moved into euphoria, wherein at 267 in around July of 2020, we wrote an article and said that, hey, Zoom, bubble, toil and trouble. And we were like, hey, this is like the market is expecting too much growth from Zoom over the next 10 years. And basically we said that, hey, this is not the numbers are not there. They don't support this valuation. And at its highest point, Zoom reached a valuation of $175 billion, which was simply unrealistic. But since then, what we have seen is a normalization in growth rates. Of course, like repeating 350% growth for over a long period of time is unsustainable for most businesses. And Zoom has basically been able to grow over that base as well. However, the market has realized that, hey, we made a mistake here, and it has consistently sold it off over the last 12 months. And really, the high was around 18 months ago now, and we are looking at an unwinding of that momentum trade. So to the downside, we are seeing it now way below its fair value because the business is consistently progressing, and I think that is where we are seeing an opportunity in Zoom. We made it a top idea on 27th January at around $140, and I think I'm happy to discuss more about why we made it a top idea today.
So the first question that everyone's going to have, right, is that Q1 22 that comes around. So they're going to report the results in a couple of weeks. So Q1 22, when they guide for the next quarterly result, it's going to be the toughest quarter of the year for them because they have the very tough comp against last year. So far, analysts are still expecting some growth off of that, which, we can kind of discuss that. But, you know me, we're not quarterly investors. We're kind of looking for a slightly longer term horizon. But if indeed Zoom is able to post any sort of growth against that first quarter, the rest of the period, the rest of the year will be just like easy sailing. But that first, how do you kind of see that? Do you suspect that the analysts are mostly right? There will be some growth there? Or do you think that they may kind of be slightly off there? How do you think about it?
Yes, so last quarter we saw around 35% jump in Zoom's paid users, which are basically greater than 10 employees. With customers have greater than 10 employees. So they have around 500,000 organizations, and Zoom has historically had a net retention rate of greater than 130%. The numbers did show some churn last quarter, but it wasn't as elevated as most people expected. Zoom's 34% revenue still come from customers having less than 10 employees, which are the very small businesses. So what the analysts are expecting is that they'll continue to see churn in that area, but the larger customers are growing their books with Zoom. So what I see is that they are doing more and more licenses, and as they continue to move up towards the bigger enterprises, I think they will be able to grow their customer base and they'll also be able to extract more revenues from their existing install base. I can take it more into the details as to how they are doing that. It's through products like Zoom Phone, Zoom Rooms, which is enabling hybrid work environments for companies which are still in the phase of returning back to office. So I think more and more companies are asking Zoom that, hey, let's do a Zoom phone setup for all of our employees. Let's set up Zoom rooms in our company because we want to adapt to hybrid environments, and some people will be working from office, some people will be working from home, and it'll be a very dynamic thing going forward. So I think hybrid work environments are here to stay, and Zoom is installed in more than 500,000 organizations at this point, and um, we don't see any reason as to why there would be like a very high elevated churn. And we also see that more and more product adoption will be there for Zoom. So we are able to see another continuation of this 130% net retention rate. So those existing users will pay more to Zoom, and that is how they'll grow. So for next quarter, we are projecting lower growth, but again, if it comes anywhere from 1.1 billion to 1.2 billion, we would be more than satisfied with what Zoom is doing. So I mean, we are happy
Yeah,
with that growth trajectory.
I think that's an interesting setup. Really, any great business is that the ability to have more products being launched over
Mhm.
time to kind of being able to cross sell to your existing customer base. Now, one of the problems that emerges is a everyone that wants Zoom probably is already on
Mhm.
Zoom, right? Also, you're having to compete against the likes of, let's say, Microsoft Teams or Google Meets. So you kind of, it's not just Zoom and nothing else, right? So there's kind of other players in the space, particularly in the case of, let's say, if you have a Microsoft package as part of your enterprise of more than 10 customers, more than 10 employees, you're already going to
Mhm.
have that distribution system for free. You're able to use Teams for free. Is that going to cause some kind of problems, you think, over the next year?
Um, so yes, I think Microsoft is probably being sold in the media as the biggest threat for Zoom. And I would say that yes, competition is going to be formidable for Zoom, especially because Microsoft can bundle its product along with its Office solutions. But I don't see it as a threat to Zoom. Why? One, because Zoom is the best of breed platform for video communications. So I've seen multiple occasions wherein um, even people within Microsoft are communicating intra-team on Zoom because they just don't like the team solution as much. Again, I think the competition will continue to improve, and maybe Microsoft will make its product as good as Zoom. So they have been, not exactly copying, but getting the features that Zoom offers. Like let's say Zoom offers filters and other things, and Microsoft has announced that, hey, we have these things in the making. So
Mhm.
they're trying to catch up with the product. But again,
Mhm.
Zoom is the innovator, and
Yeah.
Eric Yuan could be considered to be the godfather of video communications in this world because he was the
Mhm.
one who founded WebEx and then created Zoom.
Mhm.
So he's an innovator, he's a product guy himself. So I trust in his abilities to go ahead and create another product or superior services on his platform and keep adding to what Zoom is already. Now, I think Zoom can keep expanding its total addressable market. And with the install base that it already has, it can continue to expand its solutions to its users. So, I mean, one example is Zoom phones, right? So just replacing the old business hardware, business phone with a Zoom phone and creating an ecosystem of its products. So let's say you are an organization with Zoom phones and Zoom rooms installed, you are more than likely to use Zoom software to power all of these devices and keep your Zoom licenses because then all of your customers are attached to those products. And I think they're trying to build this ecosystem out. More and more organizations, as more and more organizations adopt to Zoom phones, Zoom rooms, and other availability, like they are also like giving out, let's say in partnership with companies like Five9, they are giving out the cloud contact center as a part of its UCaaS solutions, right? So Zoom is trying to build this ecosystem, create Zoom apps, which is
What's
like a marketplace.
UCA? What's a UCA system? What's that?
Yeah, it is a unified communications as a service platform. And so what that does is a company just has to go to Zoom. It's a single source vendor, and it gives you all the facilities wherein you can get video, chat, phone, um, other applications that integrate with your meeting solutions. So let's say something like Asana connects with Zoom, so that you can do your workflow management through Zoom. So while you are doing a meeting on Zoom, you can just use Zaps within this meeting and go ahead and use Asana simultaneously to manage your workflows. Assign, like during meetings, you want to assign some tasks to people. You can do that through these integrations. So Zoom today has more than 1,000 integrations, while as Microsoft Teams has around 250. So this ecosystem that Zoom has built is probably uh, gone through a lot more iterations at this point, because the product has been around for longer than what Microsoft Teams has been. Of course, you can say that, hey, competition can catch up, they could give it away for free. But if you look at the pricing environment right now, it's more or less the same. So a Zoom's basic product starts at 0 and goes up to $20. For Microsoft, it's the same thing. Despite it comes with a bundle, it's Microsoft Teams is available for $0, and it per license, and it goes up to 20. So I think in the pricing range, it's the same. And Zoom offers a different sort of the different sort of platform wherein you can integrate with different products. Teams is now slowly opening up its product to other best of breed solutions. But as Microsoft, you know that, hey, this is a provider of a huge software suite, and they would want to tie people into that software suite. So many organizations do not like that. They want to stick to best of breed solutions for each category. So I think there are a lot of such organizations out there, and Zoom's market is still not, it's the penetration is still quite low. For just the video solutions, the TAM for Zoom is around 40 billion, and their revenue base is around at 4 billion right now, right? So
Very well
there's a huge
explained.
market left.
Mhm.
Yes, I mean, there's a huge market left. And just by introducing Zoom Phone, they expanded their TAM by 20 billion, right? So there are a lot of such products out there that Zoom can introduce. If you know, Zoom tried to acquire um, Five9, which is a cloud contact center provider, an automated cloud contact center provider, and which is basically what Twilio does. So they wanted to acquire Five9 and move into this market because that would expand their TAM by another 24 billion. Now they already had a relationship or a partnership with Five9, and they are continuing to work on it. That's what the official word is from both companies. But I guess that for who Eric One is, if he wasn't able to acquire that product, I think he already wants Zoom to be working on that market. So we could expect to see some sort of product coming out from Zoom, and that's my belief that they are building it. The engineers at Zoom are building it, and they are going to create this sort of omni-channel cloud contact center, uh, which again then with automation has more opportunity there. So my point is that Zoom's story is far from over. Its customers are attached to Zoom because it provides a very comprehensive ecosystem, which ties you in as an organization. And since it is the best of breed product, it's likely to stick with customers. If it so happens that over, let's say, next 5 years, Zoom solution, there is no difference between Zoom and Microsoft Teams, and people have to choose, then comes in the network effects that are created through having a big install base. So let's say Zoom is already in 500,000 organizations today. So it's likely that some of my clients use Zoom while others use Microsoft Teams. So as a company, what I am forced to do is that, hey, half my client base is using Zoom. So I have to have Zoom licenses, whereas the other half has Microsoft Teams. So I have to have Microsoft Teams as well. So my company would have like alternate two licenses, which has, I think that such a thing has played out in streaming services, wherein consumers have opted to use multiple streaming services and signed up for them. I think this will be pretty similar, wherein people have both Zoom and Microsoft Teams, because some of their customers are on Teams and some are on Zoom. So I don't see it as a zero sum game in this sector. Uh, the best of breed solutions generally tend to win and get the almost the entire market share, but there are mostly always two or three players that the industry consolidates into. And I think Zoom is the leading product, and Teams is actually chasing it right now in terms of video. So I think it's a very competitive space, but Zoom has already established itself, and it's very hard to remove it from all these organizations. And it can continue to take market share from Teams by solely being the best solution in video. So I think Zoom has a bright future ahead of itself.
Yeah, there's certainly a big difference between being, let's say, the person that takes it from 0 to 1 versus being another kind of Me Too platform like Teams. I mean, that's clearly, Zoom itself, like just jokingly aside, but Zoom itself is a verb, right? So it's kind of like, say I'm going to go on Teams someone, I'm going to jump on Zoom with somebody. So just that ability to have the mind share of the consumer, Buffett often talks about, once you have the mind share, the share price follows. And he talks about Coca-Cola, but that's back in the 80s. But nowadays, 40 years later, having the mind share of the consumer, some people have actually said, could it not be the case in a few years that at the bottom of every website, there's like a Facebook icon or a Zoom icon? Like you could just get in touch and get very up close and personal with someone doing some kind of merchant solution at the other side. If you kind of do like Shopify or something like that, you kind of just hit a call, you kind of on a call with a person, and that's
Right.
being able to take it from, let's say, education setting or business setting to really kind of merchant setting. So it's kind of just another iteration of that. One of the things that you mentioned that's quite interesting is about this hardware. So hardware, typically, if you look at, let's say, the Peloton model or the Roku model, you sell that at cost and you try and get people kind of entrenched into your ecosystem. But the side effect of that is that creates a pressure on the margins. And if you look back to, let's say, at the peak of the pandemic, Zoom was able to have free cash flow margins of approximately 50%. And then as the revenue growth rates slow down now, we have the results up to Q3 21, the free cash flow margin is 35%. So there's a bit of a compression, not huge, like 1,500 basis points, but there's always the consideration that if you look at the business models, for example, if you look at, let's say, something like Zillow, right? So Zillow was a business, I know you're quite familiar with Zillow. Zillow was a business that was growing at a rapid rate. It was an advertising business, and its ability to grow its earnings per share were quite steady as it goes. And then it kind of got into iBuying. They weren't very successful there. But part of the reason why they unwound that business model is because it was going to create too much volatility and the margin compressions, and shareholders don't like that. Shareholders like a very easy to understand story. So there's the question in my mind that as we go into 2022, if you have a tougher revenue base, you might not have such a high free cash flow margin. And the other thing that I think in the back of my head is that if you start having to develop the hardware associated with phones, just because you're going to say you're going to launch a phone doesn't always mean that you're going to guarantee to take market share. You have countless examples of, let's say, the Android system. At some points in time, Google has tried to be quite heavy and into kind of launching phones. So there's no real guarantee. Do you suspect that over the next 12 months that there's going to be a lot of free cash flow compression, or do you think that things are going to be kind of around this 30% marker over the next 12 months?
No, so Michael, so first of all, let's understand Zoom's hardware business, what they're trying to do with it there. So they are working with hardware companies like D10 that used to provide phones traditionally. That is actually a hardware company. And Zoom is simply providing that hardware with its software. So it is still a pure software company. Zoom is going to stay a pure software company. It is just putting its software into D10's hardware and giving it to customers as a service. So again, those revenues are going to be subscription revenues. Zoom is not taking any sort of risk in terms of owning the hardware. It's of course being passed on to the hardware manufacturers. There are partners like D10, and I think there are several other partners who are traditionally these phone companies who have manufactured this hardware for years and years and years. So Zoom is not actually assuming all that risk. It's not creating that hardware on its own. It's not designing the hardware. It's simply putting its software into those phones, putting that video capability into them, and giving it to customers as a service. So it's not like that they are going to change their entire business model and shift to a hardware business wherein they see huge compression. If you look at the last 3 or 4 quarters, you would find that Zoom's gross margins have started going back up again. So what happened during the pandemic is that Zoom opened its platform from being just from business to business, or only for people who have licenses, to everyone, right? Because Eric made the decision that, hey, families want to stay connected during these times of enforced shutdowns, and we want to create Zoom as a consumer brand and let everyone use it for free. So when he opened up his platform, it got crowded by millions and millions of users, because people were doing personal communication through Zoom. Now, this was a great sales idea, because um, let's say an engineer uses it today and then goes back to his company and says that, hey, I experienced Zoom. Why not let's use it in our company for our business communications? So it was more of a sales idea. But what happened is millions of people, when they crowd the network on Zoom, Zoom has to basically, get no money for that revenue. So that is why we saw margin compression. They had to keep paying their server providers. So, and keep expanding their server network. What happened is Zoom had to actually outsource its server requirements to other cloud providers, wherein, hey, let's keep our customers, let's keep serving them, uh, even though we are taking a temporary hit on our margins. So that's what happened. The margins compressed, and now what is happening is all that network traffic is now getting outside the platform. It's going away, because people are able to meet their families once again. And so gradually those gross margins are coming back. Now, why is that not coming down to the free cash flow margin? It's because Zoom is investing heavily into its R&D once again. So if you see, there is a rise in the spending for research and development. Uh, Probably it's because Zoom is trying to find its next hero product, wherein what's next? Like, we have captured a huge market share in video. We have a huge market share via in Zoom phones. We have created all these good products. Now let's create something new, wherein, hey, we can capture another big market. And I think this is how mega companies are built, wherein you have to keep searching for your next winner and then your next winner. So I think cloud contact center is the area that he is targeting. We have identified like 4 areas of consumer software wherein Zoom could go. It could attack the area where Twilio addresses, or it could move downstream and go to CRM and say that, hey, Salesforce, we're going to compete with you. So there are a lot of things that they could do. They might not take that approach. They might take the ecosystem approach, wherein they want to just keep being a partner with all these companies. Um, but I guess they are going to want to keep growing. And how can they continue to keep pushing forward in this direction, is that they are a free cash flow machine. So Zoom is today making around 1.6 billion. Like last year in 2021, it made around 1.6 billion dollars in free cash flow. Next year, it will be making $2 billion. So with the cash flow generation of 2 billion and having 5.5 billion dollars in cash and short-term investments on its balance sheet, this is a company that's debt free. So it's going to attack all these different markets, create new products, and continue to innovate. And we have an innovator at the helm. So I think we really trust in Eric's ability to keep Zoom going over the years and create new products, create new solutions for customers. And I don't see any issues with long-term growth projections, which currently the market is pricing Zoom for a growth rate of around 9.7% for the next 10 years. The free cash flow growth rate. What we are seeing is that, hey, once Zoom solutions normalize, i.e. its growth normalizes once again, which would come around 25 to 30% per year, its free cash flow margins would actually expand from here, because its gross margins that stand at 75%, I think, right now, which would again climb back up to 80 to 82%, where they were pre-pandemic. And I think once that happens, what we'll see is that free cash flow margins once again start moving up. And when that happens, there'll be so much free cash flow falling to the balance sheet. I mean, it's just gonna be such an easy investment thesis. Like it is such an easy investment thesis right now, wherein the company could like stop growing, stop getting any new customers, and simply start a capital return program. Uh, and it would still be like buying Apple at 10 times earnings back in 2012. So it's that simple, because just because you just keep going with this program, you can keep expanding your free cash flow growth rate. And I think that is where Zoom becomes a very easy investment thesis for us.
I think that's very well described. I think, yeah, I think you've pretty much touched on everything. Just before we kind of go away, and for our listeners, can you just give it like one takeaway in a sentence of why you believe that Zoom is compelling, if you don't mind, just to sum it all up?
Yes. So today, Zoom has never been stronger as a business, and it has never been cheaper. Trading at 27 times price to free cash flow, and trading at 20 times, nearly 22 times forward price to free cash flow. It has never been cheaper. It has a long, long growth runway left in front of itself. There's a lot of expansion coming from within Zoom, and it has the money to go out and either grow inorganically or decide, or has the optionality to grow through a capital return program. Um, it's a very simple investment thesis in the sense that Zoom is installed in hundreds and thousands of organizations, and it's a very sticky product, which is very stable and growing subscription revenues. And so we believe that when with an innovator at the helm like Eric Wan, and who's just 51, so he's going to be there for um, another 10 years at least, in my opinion. So we have an innovator at the helm who will who is leading this company in the right way, through a customer centric approach, and we believe that this platform will continue to thrive despite uh, all the fear, uncertainty, and doubt around competition. We believe that Zoom is the best of breed solution and will continue to win in the marketplace.
Okay, listeners, that's it. Thank you so much for listening. See you next time.
Thank you.